What's going on YouTube? Welcome Asset here with another video, and today we're going to be talking about how the capital gains tax work. So let's get right into it. So you may be wondering, what are capital gains taxes? So a capital gains tax, it's basically a government fee on profits made from selling certain type of assets like stock investments or real estate property. So there's basically two types of capital gain taxes in a nutshell. First, you have your short-term capital gains, and what qualifies a short-term capital gain is if you buy and sell something in less than a year. So let's say you bought a share of Apple like today, and you made like $200 on it, and you decide to sell it like 2 weeks from now. That counts as a short-term capital gain because you held the asset for less than 1 year. And the other type of capital gain tax is a long-term capital gains, and that just means that you held the asset for longer than 1 year. So let's say you buy a house in 2019 and you decide to sell that house in 2021, so you held it for longer than a year. The profits that you made on that property would count as long-term capital gains. So let's learn a little more about these two. First, with short-term capital gains, so they have a much higher tax rate than long-term capital gains. And the reason that it's set up like this is to discourage short-term trading, because what that does is it increases volatility and risk in the stock market. Imagine if everyone were to just buy and sell on short term with no consequences. So the short-term capital gains is meant to incentivize investors to hold assets for longer than a year and make much more wiser investment decisions. So the short-term capital gains, they're taxed at your regular income tax rate. And because of this, it just makes sense to hold onto investments for longer than a year to avoid this altogether, because then you're taxed more if you hold for less than a year. So next, with long-term capital gains, this is the better of the two in my opinion. So long-term capital gains have a much lower tax rate than the short-term ones, as I just stated. So this is done to encourage long-term trading, which decreases volatility in the market. So the tax rate that's paid on most capital gains, that again depends on which tax bracket you're in. But those with income of less than 80,000, so if you're a married couple and you file taxes and you make less than this amount, or if you're single and you make less than 40 grand, you pay little to no capital gains tax, and it's absolutely huge. So your profits are all yours. And so let's just take a closer look at this. So this graph, what this graph explains, the capital gain tax brackets by income. So it looks confusing at first, but just focus on this yellow bar right here. This is the capital gains tax rate. So we're going to focus on individuals. If you make income, so if you make less than 40,000, you're taxed 0% on your long-term capital gains. So if you bought a stock and you make $10,000 on it and you hold it for more than a year, all of that money is yours. Now let's say, for example, you make between 40 and 435,000. You're only taxed 15% on that profit. But if you make more than, so if you qualify for this third bracket, so if you make 510 and above, you're taxed 20% on your capital gain taxes, versus short term. So this blue line represents short term. So this is your income bracket, this is how much you'll be taxed. So if you buy and sell a stock, make $10,000, and you make this amount of money, you're taxed this amount. So let's say, you know, you had like a week left to hold a stock. So like if you hold it for one more week, it would count as a long-term capital gains versus a short-term capital gains. If you held it for one more week, you would be taxed at 0% versus 12%. And, you know, if you're like a married couple and you're filing jointly, these numbers basically translate. This is just twice the amount of hair. This is just twice the amount of money, like income over here. So yeah, that's basically how the capital gains tax work. It's just smarter to hold stocks for longer than a year so that you qualify for this long-term rate, because you get to keep more of your profits, versus if you buy and sell short-term, you're going to end up giving most of that money away up to the government. So like, yeah, that's basically it. You know, that's capital gains explained in a nutshell. If y'all enjoyed this video, please leave a like and subscribe. And again, check the description to get my investing course for free. Walk and ask that here, and I'm out. Peace.
Gonna just keep running away? I'm not running.